Well, welcome back to Finance Uncut. On today's episode, silver to crash to $16, then boom to $40. So my first video I did in 2022, a huge stock market crash where I warned that we are likely to face a large stock market crash. I then followed that up with this video, Sell, 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 which I did a bit over a week ago. Once again, kind of before the market has significantly sold off this week or this past week. And I also did this video, Housing Bubble to Burst, where I argued that central banks are now going to raise rates. We'll find out how far they raise rates, but that raising of rates is going to really put a dampener in this housing bubble that we've had, as well as the stock bubble that we've had. Basically, asset prices. Now, it's not just me saying that. You know who else is saying that? Well, Peter Schiff and also former New York Fed trader Joseph Wang.
It has to do with the complete change in the investment landscape based on the arrival of inflation, the long overdue point where the dreaded monster rears its ugly head. And this is going to completely change the dynamics that have existed for investors over the last decade. Pretty much everything that worked while the Fed was inflating this bubble is not going to work as the air comes out of it. And the air is going to come out of it, despite whatever efforts the Fed may pursue to prevent that. I think they've already pricked this bubble, and there's really no way to prevent it from deflating.
I think an epic taper juncture might even be part of the plan if you think asset prices might be too high.
Now, I also did this video with legendary investor Jeremy Grantham, how he was warning that he sees about a 45% market crash coming, but he also warns or encourages or advises people that they should buy gold and silver. Now, before we come to the silver market and my predictions for it, let's just cut to a clip from Crescat Capital, and in particular listen to Kevin Smith, who has something very interesting to say and something that I've been talking about for, well, at least 12 months now.
It's really inflation that is the front runner for rising interest rates, and that's why the Fed is now trapped. That's why the Fed must move forward with its plan to raise interest rates. But guess what? You don't fight inflation by raising interest rates 25 basis points or even raising it to 150 basis points over the next 2 years, like Tavi's 2-year euro dollar chart was showing. No, that's not how you fight inflation. And so because of all the structural reasons why we have rising inflation today, I mean, yeah, we could be wrong. Yeah, some people are saying inflation is going to peak in the next quarter, and but I don't think we're going to be wrong on this one, because especially because of the shortages of natural resources, because of the underinvestment in natural resources. It's why we love oil and gas stocks right now. We love agricultural commodities and agriculture stocks. We love, of course, precious metals stocks and base metal companies, because this is where the near-term growth is. This is where the free cash flow is today among the bigger companies, the producing companies, and it's where all the M&A activity is going to be headed on the smaller companies. But just to finish up here, I just have this one chart. So to finish up on the chart and what it means is that we can calculate a target price for the S&P 500 based upon the inflation rate today. And if we think that inflation is going to structurally stay at least around 7%, where it is right now, and we actually think it is, we think it's even higher than that today, and it's likely to go even higher. But even at a 7% inflation rate, what you get is a 9% earnings yield target for the S&P 500. What does a 9% earnings yield target means? It means an 11 times multiple on the S&P 500, which gets you to a 24.40 target price on the S&P 500 based upon this year's earnings estimate, 2022 earnings estimate of $221.84 today for the S&P 500. So that's another 45% decline in the S&P 500 from here today. So we almost hit 5,000. We hit 47.97 on January 3rd, the first day of the year, the day that Apple hit a market cap of $3 trillion. And we're down about 8% from there. And it looks like we're right on the 200-day moving average. We could find some support here. I mean, I'm not saying that I'm not predicting that we're going to go to 24.40 on the S&P 500. Even I'm saying there's a likelihood. That's the downside risk right now. And if inflation proves to be more lasting, and which we think it is, that's the downside risk. And this is just history. This is just math. It's really simple stuff. And this is the risk that investors, of course, are. They have a problem today because there are way too many investors that are way too long the S&P 500 in their 401k plans, in their pension funds, in their financial advisors' asset allocation, the traditional 60-40 asset allocation. What's a 60-40 asset allocation say? 60% stocks, 40% bonds, buy and hold. Buy and hold can work over long periods of times, but when you get to record multiples for financial assets and you have a rising inflation, rising interest rate environment, you can have some real big corrections in financial asset prices. And we think that's what we face today. That's the risk that we face today. It's an opportunity, we think, for us. Never has there been a better time to be in a hedged strategy, we think, where you're short overvalued long duration assets and where you're long undervalued value commodity inflation hedge assets with really low multiples and high growth. I mean, what a great opportunity. So the S&P 500 has a lot of downside risk because it's dominated by these mega cap growth and technology companies that are overvalued. They can't sustain the growth rates to justify their high multiples today. There's still a lot of downside ahead. I'm not saying it's going to happen tomorrow or Monday or over the weekend or whatever next week. This is going to be a process. We think it's going to be a lot like the 1973-74 bear market, where over 2 years the S&P 500 declined about 50%. So it's going to be a process where you want to have a good long and short strategy to get through this time period.
So if you guys aren't following Crescat Capital, I highly recommend you subscribe to their channel. I'll put a link in the description below. They do some wonderful content, just real quality content, no over-the-top BS, just, right smack bang quality macro stuff, and obviously with a focus on the gold and silver and commodity markets. And if you're not following Tavi or Kevin on Twitter, I suggest you do. Now, in here, Kevin mentioned that it's inflation that leads interest rates. Now, everyone has been debating for years now that we're going to have a deflationary bust followed by very high inflation and maybe hyperinflation. However, I've argued the opposite. I've argued that what we're going to get is a little sniff of deflation, which we got in March 2020. Then we're going to have significant inflation. When you start to get inflation, then the psychology builds up. When people start to feel that their dollars are being devalued, then they start spending them even quicker. They try to get rid of them, and that becomes a self-fulfilling prophecy. So when we have that inflation, then central banks, because they've been accommodative with 0% interest rates and quantitative easing, are going to have to try to rein in inflation. Now, for another video. I think there are some differences between 1970s and today regarding the inflation and where the inflation is, where the problem with this is. Today it's more about government. Back in the 70s it was more about banks creating credit. Anyway, put that to one side. However, the central banks will raise rates. Yep, they won't have to raise them like they did in the 1970s. But as Peter Schiff said, it's going to pop that debt bubble. And asset prices right now have been pushed up by huge amounts of debt, both in the stock market through whether it's corporations increasing debt to buy back stocks, or retail investors getting margin debt, you name it, or in property where we've seen just ridiculous amounts of mortgage debt almost go vertical. So it'll be that pops it, and then we go into a deflationary bust. And then central banks and governments just go, right, we've got nothing to lose, let's go full MMT, helicopter currency, you name it. Then we have that big inflationary or potential hyperinflationary environment. Now, Kevin also mentioned towards the end there that he sees a 1973-74 style situation where the stock market crashes 50% in nominal terms. At the same time, that CPI was at over 12%. And I've been talking about this for nearly 2 years now, that I see a 73-74 style event where we have asset price crash or the stock market crash, yet CPI is still high. And I still see that. I see asset prices coming off, but CPI remaining relatively high. Now, it's not going to go up in a vertical line or in a straight line. It'll be choppy, but it's going to be elevated. And at the same time, back in 73, 74, remember gold actually went up over 100%. Now, I'm not saying gold's going to go up over 100% this time, but just some. I very much agree with Kevin's analysis there. So definitely, I'll put a link in the description to Crescat Capital. Follow them. Follow these gents on Twitter. They provide a lot of valuable information. All right, so here's a gold performance during stock market crashes. Now, have a look at, let's go back to March 2020. So the S&P 500 crashed 33.9%, gold was down 4.9%, and silver down 31.8%. Now, you can have a look at all the different market crashes, I guess, in the S&P 500, and gold actually goes up most of the time. There's a few times where it went down slightly. However, 2 out of those 3 times, it only just went down. So if you're holding gold, you actually increase your purchasing power versus the S&P 500. Silver, only a couple of times has it gone up while the S&P 500's gone down. And only twice have you lost purchasing power. So basically, actually once. No, only once, sorry. That's a mistake there from March. That went down less. All the other times, once again, you increase your purchasing power against stock market crashes. Now, let's have a look at March. So, as I said, that went down 33.9% and silver 31.8%. All right, so having a look at the silver chart. Now, if we get that market crash, so if, let's say the stock market falls 40%, we have a liquidity event very similar to March. Okay, so silver fell from $18 down to $12. Actually, it just poked its head below $12 from memory. But then it shot up to 30. Okay, so let's say the market goes down 40% and we get a liquidity event and silver goes down 35%. So let's say silver goes down 35% from last week, $24.50 from its high at $24.50. So we're looking at $15.92. Let's say $16. Okay, so at that point, as I said, I still think we're going to have CPI, high CPI, and I think then we start to get central banks reversing course, still deep negative yields, I think people will be scared to go into the stock market. And I think we're going to get that liquidity and that capital inflows into gold and silver, very similar to March last year. And so if we see something replicated, so if we see 150% gain from $16, from a base of $16, then we're looking at $40 silver. However, based on, history, silver actually might not go down as much as the S&P 500, especially at these elevated levels. There is less from retail traders and retail investors. There's less margin and less debt in the silver market compared to the S&P 500. So I could see the S&P 500 actually falling significantly more than silver. So, if the S&P actually falls 40%, maybe silver falls 20. But as I said, we just did that example at 35. And in December, I did this video, inflation 15%, silver boom 2022, basically giving my predictions for 2022. And as you can see in red there, I said that at some point in 2022, silver's going to hit $30 and then $40. Now, I have been warning about this stock market crash, and if that comes and we have a liquidity event, silver is going down in the short term. And back in March in 2020, I said I backed up the truck and I loaded up on silver. And so my silver's performed extremely well. And so if we do see silver fall to $16, I definitely think that's probably a worst case scenario. It might only fall to $20 or $18. Then we'll see that jump back up to $40. So if it let's just say it copies March 2020, it's going down to 16, then it's going to bounce up to hit $40, which is right on my 2022 prediction. So what should an investor do? Well, look, one of the reasons why I like holding gold is it really is that insurance play. Now, I've never sold my gold. I've just accumulated it bit by bit. I've never sold any of my gold. And so if you feel more comfortable, if you think silver, you just can't, you just can't stomach that volatility. You just can't stomach silver going down maybe 35% if the market does fall 40 or 45%, then maybe you should be in gold instead. Or, if you want, go move to cash if that's what you really want. Now, I am sitting in a lot of cash. I've got a large part of my portfolio in cash. And this whole thing we're about to face is set up beautifully for this position. So I'm sitting in cash, but in US dollars. So a portion of my portfolio is sitting in US dollars. Now, just in the last week, our Aussie dollar has fallen to almost 52-week lows against the US. Now, if we have this liquidity event, and there's some signs that this liquidity event could be quite severe. I believe was it JP Morgan or Goldman Sachs I read their liquidity scenarios or something is flashing red. So anyway, then the Aussie dollar, and if we go back, if we have another March event, well, the Aussie dollar fell to 56 US cents. So I will then convert those US dollars into Australian dollars. At the same time that silver has been maybe beaten down, definitely the gold and silver stocks have been beaten down. And in Australia, we've got wonderful, high quality gold and silver stocks and explorers. And in fact, I've just had an explorer just recently announce that they've found 35 kilometers worth of gold. So it's going to looks like it's going to be a huge discovery. And that stock since October last year has gone up from about 23 cents to, as of today's recording, which is Friday the 28th of January, is now sitting at 90 cents and has a market cap of just under $40 million. And so it doesn't have a lot of shares on offer. And so if this discovery does turn out to be a big whopper, then this stock has got a lot more upside from here. So very happy with that stock. But there's going to be other stocks that are being beaten down. So that cash, I'll convert that. It's basically Brent Johnson's dollar milkshake theory playing out, and Brent actually thinks our Aussie dollar is going below 40. As I said in previous videos, I won't be waiting that long. I will convert if the Aussie dollar falls to around the 50 US cents, and then I'll be deploying it into silver. So once again, I'll be backing the truck up into that. So anyway, what do you guys think? That's just my opinion. Love to see your thoughts and opinions in the comments below. If you like this video, please hit that like button. Really do appreciate it. Take care, guys, and I'll see you all again on another episode of Finance Uncut.